welcome to Cambridge House Live. I'm Vanessa Collette here at the Canadian Investor Conference, Toronto. I'm thrilled to be joined by Danielle Park again, the President and Portfolio Manager for Venable Park Investment Counsel, and also you write for Juggling Dynamite, which is your regular blog that you put out.
Right.
It's great to see you again, Danielle.
Yeah, you too, Vanessa. Another year.
Absolutely. Now let's start out by talking about currency, because you were saying that that's something that you see as kind of driving everything else. So what's your take there?
It is. So the currency markets are, the biggest, most liquid asset markets in the entire world, and I think a lot of people miss the significance of that. For example, when commodities were soaring, from 2002 to 2008, the main catalyst behind that was the falling U.S. dollar, which was in fact falling all the way from 2001 all the way into the bottom of 2008, when it rallied in the financial crisis, and you saw everything sell off, sort of in a negative correlation to that. And I think that the last few years, the rising US dollar has once again, it's entered into a secular uptrend, which took so many people by surprise.
Absolutely.
And that has in fact been, to the detriment of the same things that it benefited when it was falling. Now it's taking away from commodities, gold, silver, all the things that people had fallen madly in love with before.
Right. And I don't know, do you think that people are looking at the US dollar as a safe haven right now? Because, you said it surprised a lot of people. Did it surprise you?
No, thankfully. It was one of the trends that we've really, from a top-down macro perspective, it was one of the trends that made a lot of sense to us.
Okay.
We are sort of long students of the duration of cycles, so we knew that, that the currency typically runs 7 to 10 year cycles. And so the benchmark currency was not going to fall forever in our view, and it was just a question of trying to figure out where support was historically and that sort of thing. So now you have, for example, today the US dollar index is breaking out through 85, and against the Canadian dollar, that's pretty significant. The Canadian dollar's been falling since 2011 again, when it rebounded to 105, and now is around 90. So we think that there's a good chance that the Canadian dollar could reclaim the 70s as against the US dollar in the next year or two, and that will continue to be negative for things like commodities. It's also relevant to things like the carry trade, Vanessa. So, when you saw a lot of speculation in equity markets the past couple of years, that was fueled by borrowing in places like the Japanese yen, where rates were next to nothing, and the currency was stable and rising. So people were able to borrow borrow in yen and invest in or speculate in other asset markets. Well, in fact, that's now reversing as well. So you have weakness in the euro and weakness in the yen, which means that those carry trades are unwinding. And I think, again, that's taking people by surprise. So,
I think that's kind of been my theme for today is the US dollar strength really standing on its own 2 feet, or is it just relative to the euro and the yen because of all the liquidity that we've seen there recently?
Well, you see, it's always relative, though,
it is.
right?
It's
so,
exchange.
I always say, if you have to put your money, your capital somewhere. If you have excess savings, if you're fortunate enough to have excess savings, you have to put it somewhere, and under your bed has a lot of risk as well, right? So it's always relative, and I think that you need to have things that are liquid, and I think the financial crisis really showed people that a lot of things they thought were liquid and traded, it just evaporated. You couldn't get a bid on most things. So people have really sort of shied away from, putting a lot of allocation into some of those things like high yield debt. Lots of run up in that price, but not a lot of people on the bid side in that space right now. And I think that will probably continue as concern spreads here. Because the other thing that's remarkable about the past 2 years is the QE belief phase, I called it, where people thought that they would never taper, that the US Fed would just...
I was a believer.
And I always thought, well, things that can't continue indefinitely simply don't. And so indeed they've tapered, right? And so now you look around with Draghi trying to come up with some version of QE liquidity and the euro weakening,
for the first time.
Something like that. You've got China desperately pumping money into banks again. You've got, poor Mr. Abe in Japan coming out with his 22nd year of QE.
Radical experiment.
He's increased the balance sheet 78% in Japan in the last, 2 years, basically. And what did they get? They got a contraction of 7% in the last quarter of their GDP. So it's just not working at all. And I think that at the point where the S&P and things like the broad market in Canada start to sell off, which if you notice this week, everything's red. It's not certain things are up and certain things are down, it's everything's red.
Across the board.
Because once the liquidity trade reverses, you see that everything leaves at once. That's the condition we've been in. We've had everybody kind of participating in the QE belief phase, liquidity kind of pumped up a bunch of things all at the same time. Remarkable run, right? The S&P straight up. You know, in the last 2 years, straight up, no 10% pullback, 77 new closing record highs, Vanessa.
It's quite the chart.
But as Harry Markopolos pointed out, when he was the guy who was telling everyone for years that Bernie Madoff's scam was not actual genius, but actual fraud and a Ponzi scheme. And he said, you know, I could tell in 5 minutes that it was because it went straight up in a straight line.
Right.
And in finance, nothing goes in a straight line. So you should think about that when you look at the trajectory of the S&P and things like the Canadian banks the past 2 years on that QE belief phase that they would never stop and that it would never let asset prices go down. I think you could see some pretty straight lines on the way down again now as that belief corrects. And that's indeed what you're seeing. You're seeing, you know, double 200 and 300 point moves down on things in a matter of days. And that's, you know, people have fallen asleep at the switch. They've had no concern. There's been no bears, Vanessa. There's been, you know, a record number of bullish commentators in the past couple of years.
It's too good to be true. It probably is.
It probably is. But here's the really exciting point.
Okay.
For those who are prepared and understand the secular cycle, we need one more cyclical washout here, probably to complete the secular bear cycle that began from the crazy peak in 2000. We've had 2 really good washouts in the last 15 years, and I think we're setting up for the 3rd here. It's not an if, it's a when, okay? And if you can be prepared to benefit from that, you can get a generational low in some of these, quote, dividend-paying stocks and things that people thought were ironclad and conservative. They're going to realize that they aren't and that they're going to drop a lot very likely in this next down phase. And that will be the time to have cash to deploy, you know, to take advantage of that. So as you've seen with the commodity space, the Chinese stock market, the tech bubble in 2000, over that secular downturn, things come back 70% from the peak. Okay, we've seen that in those other markets. We saw that in the Japanese market when it came off from its bubble peak in 1990. So I'm talking about downside for something like the TSX broad market around possibly 6,000, 7,000 in that range, and the S&P back, you know, 800-900. Just like we've seen with the venture, right? So that's sort of the template. And if that sounds horrifying, that's because you're not prepared for it.
Well, how can investors position themselves? You know, what are you advising your clients to do?
So you have to keep real liquidity. That doesn't mean, you know, things that 3 people are trading in and algos are pumping up every day. Because when you go to find a buyer, you'll find that they're already in. And when you want to sell to someone, you'll find that all the fools are in. And there's no one to take it off you, right? So that's the first thing. Real liquidity is actually cash, okay? Not something you have to sell to get the funds to buy something else. And you have to be very careful with how much of your money you leave passively allocated to anything that's in the category of extremely overvalued right now, which is a lot of things. A lot. High yield debt, equities, Canadian financials, off the charts.
What do you think of tech? Is that...
So tech, you know, tech relative to things like the Canadian financials maybe has a little bit of an advantage, but not a lot, because frankly, it's been in a mini bubble boom in the last few years as well. You know, the Silicon Valley space, you know, likes are not earnings, no matter what people tell you, Vanessa. Clicks sound great, but there was a report recently that said 60% of the click data that's reported is actually fabricated and false.
Oh, it's very easy to purchase, I guess.
It's very easy to purchase, so you have to be really careful. There is some really exciting things that have come out of the social media space, but they're not an end in themselves. They tend to be a promotional tool. So you have to look at companies that actually have a business model that serves, that's not...
Let's look at Alibaba. I mean, is that for you, do you see that as a top, or is that,
well,
are they
it's
fairly
certainly
valued?
Insane valuations. I was there in the tech bubble as well, and I remember when everyone started telling me my little CFA measurements made no difference because earnings didn't matter, and ratios and multiples didn't matter. It was all about sales, not earnings. It was all about EBITDA, not net. Things like that. So I remember this now. I've been through this a few times, and I think that it'll prove to be false this time as well. So it's really, again, people forget that there's a difference between the investment cycle and the stories of the companies. The stories of the companies, the people telling you, the founders, could be just awe-inspiring. But if you don't understand the investment cycle of it, if you don't know that you're at 6-year highs, for example, that valuations are overdone because everyone's been bullish and no one's been seeing downside, that should be a reason for you to take an opposite tack, not follow the herd right over it. Yeah, not follow the herd over the cliff. And ultimately, it's not a dark story. It's an exciting story. But you have to first realize where you are in the cycle, and you have to be extremely patient. You have to pick your discipline and wait for it. The worst thing people do is they change their method or their approach, what they've decided to do, they change it.
As they go.
Whether they change that at the top and capitulate and start buying because everybody's in and they're missing out, or whether they do that at the bottom and when they meant to buy and hold, but then they panic because everything's down and they sell. You can't do it either way. You have to really pick your discipline and have the guts to stick it. And if that means that you've sold and you're out of equities and you've got cash and T-bills and US dollars and everything's set up, great, but you have to wait for that opportunity to earn it.
So it sounds like the best thing to do right now is just have cash, be liquid, and get ready to profit from coming downturn.
Yeah, have your buy list ready. Do your work now so that you know what you want to buy and how much of it, and not dependent on someone else telling you when to buy.
Great. Well, Danielle, it was great having you on the show today. Thank you so much for joining us.
Thank you, Vanessa.